As a finance nerd, I love nothing better than getting stuck into a balance sheet. A balance sheet, or to use its correct name, statement of financial position, is one of the most important financial documents a company has. A balance sheet shows the current financial position of a company at a specific date. The key pieces of information the balance sheet includes are the accounting values of assets and liabilities and the owner's equity of the business. In the previous video, we took a brief look at what went wrong at former childcare centre operator ABC Learning. In this video, we'll use ABC Learning's balance sheet to explore the relationship between assets and liabilities on a balance sheet. But before we do this, let's refine our understanding about assets, liabilities, and owner's equity. Put simply, assets are resources controlled by an entity that are expected to produce revenue over time. Physical assets include things like the property, plant and equipment an organisation uses to produce revenue. In ABC Learning's case, its main physical assets were the childcare centres it bought from other childcare centre operators. Aside from physical assets, assets also include intangible items like a business's brand, as well as the goodwill associated with a business. Goodwill is the good reputation of a business that allows it to earn higher profits than an identical business with a lesser reputation. When ABC Learning bought a childcare centre, it also acquired the goodwill associated with the centre. On a balance sheet, assets are divided into current assets and non-current assets. Current assets are expected to produce revenue and profits for an entity within 12 months. For ABC Learning, its current assets included things like the money owed to the business for providing childminding services. Non-current assets are expected to produce revenue and profit for an organisation for more than 12 months. For ABC Learning, this included things like the childcare licences attached to the childcare centres it bought. These licences were valuable because they're only granted to childcare centres that have shown they meet the appropriate standards to take care of young children. The licences it owned to run childcare centres were ABC Learning's main asset. They allowed the operators of the childcare centres ABC Learning owned to use its physical assets, childcare centres, to run a business and make a profit. Now let's take a look at the concept of liabilities. A liability arises when one party provides goods or services to another party in the expectation the second party will pay back the first party for the goods or services, usually at an agreed time in the future. Similar to the concept of assets, a balance sheet will include current and non-current liabilities. A current liability is expected to be repaid within 12 months. For ABC Learning, current liabilities included things like money owed to the business's regular suppliers. For example, money owed to businesses that supplied ABC Learning's childcare centres with children's books and toys, for example. On the other hand, non-current liabilities are expected to be repaid over a period of more than 12 months. They included things like ABC Learning's significant long-term debt used to buy childcare centres to expand the business. The third main component of a balance sheet is owner's equity. Equity, also known as net assets, is the financial interest the business's owners have in the value of the assets in the business minus the business's liabilities. Let's explore a couple of key concepts associated with equity. The first is issued capital, which is the value of an entity's shares issued to owners in exchange for their cash, services or assets. The second is retained profits. These are profits kept in the business rather than distributed to the business's owners. In ABC Learning's case, issued capital increased substantially over the 7 years the company was in business because the company was regularly selling shares to raise funds for expansion and was also issuing shares to buy childcare licences. Now let's turn to the complex concept of value. In accounting, the way assets and liabilities are valued on a balance sheet is set out in accounting standards. Under these standards, assets are valued in one of two ways: at historical cost or at fair value. Historical cost is the amount paid for the asset, and fair value is generally the market figure. Whichever method is used, the value cannot exceed the recoverable amount, which is the higher figure of value in use or fair value. Value in use is the cash flow the owner of the asset would expect to receive by using it to generate revenue. Now let's have a look at the way asset valuation worked at ABC Learning. When ABC Learning listed on the stock exchange in 2001, the value of its assets were a little over $28.5 million. But by 2007, ABC Learning's asset values had increased more than 1,000% to more than $4 billion. The increase in asset values was largely due to the company buying existing childcare centres, including their licences and physical assets and the goodwill associated with these centres. On the company's balance sheet, the value of these childcare centres increased from a little more than $20.2 million to more than $2.8 billion between 2001 and 2007, also an increase of more than 1,000%. ABC Learning issued shares and went into debt to buy these assets. The former owners of the childcare centres were paid with either cash or ABC Learning shares or a combination of the two. But before it could raise the debt to buy the centres, it had to value the assets it was buying. 2007 was a watershed year for the business. ABC Learning paid just under $870 million for the childcare centres it bought in 2007. This figure includes almost $700 million for the childcare centre licences attached to these childcare centres. But when they were bought, the balance sheets of these childcare centres only valued the licences at $58.5 million. ABC Learning used fair value to arrive at the $700 million it paid for the licences, believing it could generate cash flows of $700 million from these assets, which, remember, were originally valued at just $58.5 million. The childcare licences were initially recorded at cost, which is considered to be fair value with reference to an active market. Cost is treated as fair value because of an exchange between a buyer and a seller. But in this case, as it is questionable whether there is an active market, the fair value is difficult to substantiate. As the biggest player in the childcare market, ABC Learning set the market price for childcare centres. So the question is whether, as the biggest player and price setter in the market, fair value was an appropriate valuation method. As history shows, the company's collapse indicates the purchase price was way too high, much higher than the real value of the assets.